So yeah, the red light is on. I think we're actually recording now.
Oh, wait, we're going. Okay.
Yeah, we're live. So look, this is the first of these Joinprop deep dives. I'm the head of content over there. And sitting across from me is the skeptic. Exactly.
Basically the proxy for anyone listening to this right now who has, a regular job, doesn't stare at moving charts all day, and is just genuinely confused by all of this, which is exactly why I'm here, I guess.
Right, the non-trader. Which is good, honestly, because the prop trading space, especially now in 2026, it's complicated, really complicated. So I want to walk through this. Wait, let me back up, actually. Let me start with this. There's this acronym I came up with to try and explain the whole prop firm landscape to people who are just coming into it. VIPER, V-I-P-E-R. It stands for Verify, Investigate, Profile, Evaluate, Research. If you just...
Okay, stop. VIPER.
Yeah.
That is an incredibly aggressive corporate name for a checklist. VIPER. It sounds like an 80s action movie villain or like some tactical body spray. I mean, honestly, before we get into like military-grade acronyms, I just need to know what this actually is. Because from the outside, looking at the ads that flood my feed every single day, the guys leaning on rented Lamborghinis, the flashy lifestyle stuff, it sounds sketchy.
Yeah, the marketing is...
It sounds fake. Like, why would a firm just give me their money to trade? What is the actual catch here?
Okay, the catch. The catch is... You know what? Let me just abandon the framework entirely. Throw VIPER out the window.
Good.
I'll just give it to you straight, because you're right. The marketing out there is garbage. The primary way these prop firms make money, it isn't from winning trades in the live market. That's the big secret. They make their money from evaluation fees.
Evaluation fees. Okay, so you pay to take a test.
Right. You pay a fee to prove you can trade. You basically say, hey, I'm good at this. And they say, cool, give us $50 or $100 and prove it on a simulator. And if you look at the actual data on this, like the raw behind-the-scenes revenue numbers for the industry firms make anywhere from 70 to 147% of their total revenue from those evaluation fees.
Wait, 147%?
Yeah.
I need a second. First of all, mechanically, how can a number be over 100% of revenue? And second, that means they profit mostly when people fail. Wait, that's literally their business model.
Okay, so the over 100% thing, it happens because of trading losses on the funded side. Basically, the evaluation fees are pulling in so much cash that they offset the money the firm loses when their actual funded traders screw up in the live market.
Oh my God.
The core income, the engine of the entire business, is the fees. And look, it's a gauntlet. It's an elite performance arena.
No. That feels like a total scam.
It's not a scam.
If the house makes all its money on people failing the entrance exam, the system is rigged. You're charging people to fail.
It's not a scam.
I'm not saying it's strictly illegal. I'm saying it feels like one. You're selling a dream to desperate people, right?
Yeah.
People who want to quit their jobs, people who see the Lamborghinis, and you're just cashing in on their failure.
Those are two very different things, okay? Selling a difficult challenge is not the same as running a scam. Let's be clear about the history here, because context actually matters. A few years ago, yeah, it was a Wild West, absolutely. But the 2026 shakeout completely wiped out the B-book firms.
B-book? What is that?
Yeah, so a B-book firm is a term from the broker world. It means a firm that internalized the trades. They didn't actually put your trades into the real live financial market. They just played the house. You're essentially betting against the firm itself.
So,
because you lost $100 in the market, the firm literally kept your $100. They profited off your direct simulated trading losses. And because they controlled the simulator, they could, and some did, mess with the data.
Oh, wow.
They'd widen the spreads, introduce server lag, basically hunt your stop losses to make sure you failed.
So they were literally a casino posing as a Wall Street firm.
Exactly.
Yeah.
And those guys mostly got regulated out of existence or collapsed when people caught on. The survivors today, the ones we actually talk about in the industry on this deep dive, they use A-book models.
Meaning what?
Meaning they pass your trades to real liquidity providers. They connect you to the actual market. If you make $1 million, the firm isn't paying you out of their own pocket and going bankrupt. The market is paying you.
Right.
The firm takes a cut of your actual real-world profits. So they do want you to win, eventually.
But you literally just told me they make 147% of their money on the tests. If they want you to win, why is the test generating all the cash?
Because trading is insanely hard. People do not respect the market. That's just the reality of it. You have thousands of people who watched one YouTube video on candlestick patterns, and they think they're the next George Soros. They buy an evaluation, and they blow it up immediately.
Okay, but
The failure rate is staggering. Take a guess. What percentage of people do you think actually pass these challenges?
I don't know if it's that hard. 50%. Higher. Seriously.
Is that going?
75. If it's higher than 75%, this whole thing is a joke.
It's 80 to 95%. 80 to 95% of traders fail these challenges.
95% fail. My God.
Yeah, it's brutal. But, and this is the crucial distinction, it's not because the firm is actively manipulating the market anymore. It's because people don't have risk management. They get greedy. They over-leverage. So what happens is you fail the test, you blow past the loss limit, and then you have to buy a reset.
A reset so you pay them again?
Right. You pay to wipe the slate clean and try again. But they discount it to, soften the blow. Like Apex offers 40% off your reset fee. Top Step does 30%.
Of course they do.
It makes you feel like you're getting a deal on your second try. Or your fifth try. Some of them, like Tradeify Select, they've introduced this auto reset feature.
Auto reset? Like it just charges your card without you asking?
Well, you opt into it.
Yeah.
But if you blow your account, it just resets automatically on your next billing cycle. You don't have to log into a dashboard and manually buy a new test.
Auto resets, like a subscription service for failure. You just proved my point. That is exactly how they hook you into a cycle of spending. It's a treadmill. Yeah. You fail, your card gets dinged. You wake up the next morning and the account is fully funded on the simulator again, so you just keep pulling the lever. It's a slot machine.
I mean, you can cancel it. It's not like they hold a gun to your head. It's just convenience for day traders who don't want to deal with admin stuff mid-session. If you're in the zone and you hit a drawdown limit, you don't want to spend 20 minutes entering your credit card info.
I guess, but still.
But yeah, if you don't know what you're doing, it's a fast way to drain your bank account. You have to know what you're doing. So if we look at how people actually try to get in, how they tackle this gauntlet, there are basically two paths: the one-step challenge and the two-step challenge.
Okay, before we even get into steps, if 90 to 95% of people are failing, how are the other 5 or 10% surviving this test? What actually is the test? What are you trying to do?
Okay, so the evaluation, the test itself, is essentially a math problem. It's about hitting a specific profit target without hitting a drawdown limit. Drawdown is just a fancy word for how much money you're allowed to lose.
Okay.
So a one-step challenge is fast. It's designed for people who want capital right now. You can get funded in 3 to 7 days. But because it's only one step, you have to hit a really high single target, usually like 8 to 10% profit on your starting account balance. And it costs more upfront to buy that test.
Wait, 8 to 10% in a week? That sounds like gambling. In the real world, traditional investors are happy with 8% in a year.
Exactly. And that's the trap. It kind of forces you to be aggressive.
Yeah.
To make 10% in a few days, you have to take massive risks. You have to trade huge position sizes, which is why the failure rate on one-steps is so astronomical. A lot of people realize this. So they go for the two-step challenge instead.
Which is what?
It's more methodical. It takes maybe 10 to 20 days minimum, sometimes more, depending on your strategy. They split the targets up so you don't have to swing for the fences all at once. So phase 1, you need to hit maybe 8% profit. Once you do that, you move to phase 2, where you'll need to hit 5%.
So it's slower. You aren't rushing.
Slower. Usually a cheaper initial fee to buy the test, and they give you better buffers for your drawdowns. You get a little more breathing room to make mistakes. And the stats on this are pretty wild. The pass rate for a one-step challenge is only 10 to 15%. But the two-step pass rate is 18 to 22%.
Okay, wait. I'm thinking about this. Let me just logic this out. If the two-step feels safer because you have more breathing room and it's actually cheaper up front to buy, more people are going to buy it.
Yeah, it's the most popular product by far across almost every firm.
But it takes 20 days. You have to actively trade without hitting a loss limit for nearly a month. They are basically keeping you in the market longer. You're exposing yourself to more news events, more weird market swings, more chances to just wake up in a bad mood and make a stupid mistake.
Right.
It's a psychological trap. It looks safer on paper, but the longer you play a game where the odds are against you, the more likely you are to trip a wire.
I mean,
yeah.
You're not wrong.
Yeah.
Mathematically, the longer you are exposed to market variance, the higher the chance of hitting a drawdown. That's just statistics. If you flip a coin 100 times, you're going to get a streak of tails eventually. But from an expected value standpoint, like pure EV math, A 22% pass rate is still objectively better than a 10% pass rate. A better expected value for your dollar. But you have to survive yourself. You have to have the discipline to not get bored and take a dumb trade on day 14 just because you want to get it over with.
I'm fixated on these costs, though, because you keep saying for your dollar. Okay, so I buy the test. Say it's $150. I fail. I buy a reset for, I don't know, $100 with the discount.
Yeah.
Let's say I actually manage to pass this 20-day psychological trap. I'm in the elite 10%. What is this actually costing people in the real world? Like, bottom line.
Okay, so internally, we talk about the TCF, the total cost of funding.
Yeah.
Because the advertised price, the price you see on the Instagram ad, that is never the final price. You have hidden fees.
Of course there are hidden fees. It's finance. Like, what? Give me the itemized receipt.
Activation fees, for one. Passing the test isn't free.
Are you kidding me? Wait, I pay for the test, I take the test, I pass the test, I literally prove to them that I can make them money, and I have to pay them to start working for them.
Yeah, pretty much. Apex charges up to $140, sometimes more depending on the account size, just to activate a past account. Aqua Futures has a one-time setup fee of like $149 to $166.
What is an activation fee even paying for? Pressing a button.
They claim it covers the administrative costs of setting up the live data feed and the risk management software for your specific live account. Now, to be fair, some firms don't do this. Tradeify Select is $0 to activate. But for the vast majority, it's a very real thing you have to factor into your budget.
Okay, what else? What else is on the receipt?
Data fees. The stock market, the futures market, they don't just give out live price data for free. The exchanges charge for it. If you aren't using a specific partnered platform like Tradeivate, you're probably paying an extra $60 a month just for the live market data feeds. Yeah, if you don't pay it, your charts are delayed by 15 minutes, which makes day trading literally impossible.
So I'm paying a monthly data bill just to see the screen.
Right. And then there's the reset accumulation we talked about. Let's look at a place like Phidias. Their reset is $59. Let's do the math on a totally average trader.
Okay.
If it takes you 4 tries to pass a 2-step evaluation, which is completely normal, you're paying the initial evaluation fee plus 3 resets at $59 each, plus the activation fee when you finally pass, plus your monthly data fee. You could easily be $500 or $600 deep before you ever make a single real trade.
This is exhausting. This sounds like an absolute nightmare of nickels and dimes. Can I just bypass the test? Like, if I'm listening to this and I already know how to trade and I have some cash,
Yep.
Can I just pay them more upfront to skip the evaluation phase and just start trading their money?
You can. Yeah, it's a newer model called instant funding.
Seriously. You
Right.
can just buy your way in.
Yeah, places like FXIFY or Aqua Futures do it.
Yeah.
But it costs like 50% more upfront compared to a normal evaluation, sometimes double.
Right.
The firms do it because they prioritize what they internally call liquidity velocity. They want capital moving in the market, generating returns right now. They don't want to wait a month for you to prove yourself if you're willing to put down a massive security deposit, basically.
Liquidity velocity. Okay, I know you're the head of content, but that is just corporate speak for exploiting impatient people. You're telling me people fail the test a bunch of times, get frustrated, and then the firm says, hey, don't worry about the test, just pay us a massive premium to skip the line. That's predatory.
It's not just for impatient people. Look, I get why you're reacting like that, but for a consistently profitable trader who just needs capital, the math actually makes sense. Think about it. Why spend a month of your life proving yourself on a simulator, stressing about weird evaluation rules, and paying reset fees, when you can pay a premium, get funded today, and start making real, actual profit splits tomorrow? For a pro, it's just a business expense. It's ROI.
If you're profitable, which 95% aren't. So they're offering a bypass to people who already have a gambling problem.
Right. If you aren't a profitable trader, instant funding is financial suicide. You are just handing them a massive chunk of cash that you will immediately lose when you hit the drawdown limit on day 2. But the option exists because the professionals demanded it.
Okay, let's talk about these professionals, because you're telling me about $59 resets, $140 activation fees, monthly data feeds, premium skip the line fees. It sounds like all the money flows in one direction from the trader to the firm.
Well,
do these companies actually pay out? Has anyone anywhere actually seen this money, or is it just numbers on a screen? Because right now I'm picturing a bunch of guys sitting in a basement in the Bahamas just collecting credit card payments.
oh, they pay out. I knew you were going to hit me with this, so I actually brought the receipts. People always ask this, and it's a fair question given the B-book history. Let's look at Apex Trader Funding. They are one of the biggest players in the space. Since 2022, they have paid out over $598 million to traders.
Wait, $598 million?
$500 million.
Yeah.
$500 million.
And just in the last 90 days leading up to this quarter, just the last 3 months, they paid out $56 million.
Okay. Wow. I honestly didn't expect that. That's a real number. That's not monopoly money. $56 million in 90 days.
It validates the industry. Like I said, it's brutal, it's unforgiving, but it is real. The money is absolutely there. You just have to be in the tiny microscopic percentage of people who have the discipline to actually extract it.
But how do you even verify that, though? Anyone can code a website and put a big flashing number on it saying, we paid out $1 billion. Yeah. How do I, as a listener, know that's not just marketing fluff? You don't trust their website. You check third-party platforms. Trustpilot is absolutely huge in this space. It's basically the only way these firms survive, by maintaining a public reputation. A firm like the Fivers, for example, they have a 4.9 out of 5 rating.
Out of 5?
Yeah. And that's not from 10 people. That's from like 19,000 independent reviews. And the real metric you look for isn't just the star rating, it's how they handle the negative reviews. The Fivers responds to 92% of complaints within 2 weeks. They actively resolve issues publicly. Or look at Rebels Funding. Their whole marketing gimmick is that they process payouts every 12 hours.
Every 12 hours, so twice a day.
Yeah. The days of waiting 30 days for a sketchy wire transfer from an offshore bank while hoping the firm doesn't vanish into the night are mostly gone. The reputable ones pay fast, usually via crypto or direct bank transfer, because payout proof is literally their best marketing tool. When a trader gets a $10,000 payout, they post a screenshot on Twitter. That screenshot brings in 50 new people paying evaluation fees.
Okay, but wait, I'm thinking about the mechanics of this. If they are paying out $500 million, that is a massive liability. They must be actively trying to stop you from winning. Like, if I'm running a business and I'm on the hook for $56 million a quarter, I am making the rules as difficult as legally possible. The rules have to be designed to trip you up. So what are the actual rules?
So the rules are shifting. It used to be arbitrary stuff, but now it's all about institutional compliance. They want you trading like a real Wall Street desk.
Yeah.
The biggest, most complicated thing is drawdowns. You've got your trailing drawdowns versus your dynamic drawdown.
Okay, stop. Stop right there.
What?
You're assuming I know what a dynamic drawdown is. You're doing the thing again. You're getting into the weeds. Explain it to me like I'm not a Wall Street bro. Explain it to me like I'm a normal person sitting in traffic right now.
All right, sorry. Okay, let me simplify it. A drawdown, at its core, is just how much your account is allowed to drop from its highest point before the firm says you're too risky and they take the account away from you. Usually you have a daily limit of like 4 to 5% and a total overall account limit of 5 to 10%.
So just to do the math out loud, if I have a $100,000 funded account and I lose $5,000 in a single day, I'm fired.
Exactly. You lose the account. But it gets incredibly tricky with how they calculate that $5,000. Let's talk about the trailing drawdown. Imagine you're climbing a mountain, right? And you have a safety rope attached to you. But this safety rope only pulls up. It never lets out slack.
Okay, I'm with you.
So you start at base camp, $100,000. Your drawdown limit is $5,000. So the floor is $95,000. You climb up the mountain. You make $2,000 in profit. Your account is now at $102,000. Because it's a trailing drawdown, your safety rope pulls up. The floor moves up by $2,000 too. Your new failure point is $97,000. It locks in your risk.
That doesn't sound terrible. It protects the profits.
It sounds great until you realize it tracks your open profits, not just your closed trades.
Wait, what does that mean?
Let's say you are in a trade. The market shoots up. You are up $5,000 on paper. Your account hits $105,000. The floor trails right behind it, moving up to $100,000. But you haven't closed the trade yet.
Uh-oh.
Suddenly the market reverses. The price drops back to where you started. You close the trade at break even. Your account is back to $100,000.
Okay, so no harm, no foul.
Wrong. The floor moved up to $100,000 when you were up on paper. It doesn't move back down. So your account balance is $100,000 and your failure point is $100,000. You are instantly fired. You lose the account, even though you didn't actually lose any money.
Are you serious? That is insane. You get punished for making money if the market fluctuates before you close the trade.
Yes. Honestly, a lot of traders absolutely hate trailing drawdowns because it forces you to close winning trades early just to prevent the floor from dragging up too high. Messes with your psychology. A dynamic drawdown is slightly different. It can fluctuate based on closed trades rather than open equity, but every firm has its own weird formula.
That sounds completely nerve-wracking. It's like playing a video game where the screen is constantly scrolling up, and if you touch the bottom, you die. What else? What other traps are there?
The Wild West is over, like I said, so they enforce lot size consistency now.
Meaning what? What is a lot size?
A lot size is basically how much money you are betting on a single trade. So consistency means you can't just plug along making tiny, super safe micro trades for 29 days, making $1 here and $1 there, and then suddenly, on day 30, bet the entire farm on one massive trade to pass the evaluation challenge at the last second.
Why not? If I hit the profit target, who cares how I did it?
Because the firm is evaluating your risk profile. If your average trade size for a month is one contract and suddenly you open 50 contracts, they will instantly fail you for inconsistent trading. They want to see a repeatable, boring strategy. They do not want gamblers. If you are gambling, eventually you will lose their money.
That actually makes sense. I hate to admit it, but that sounds like actual responsible risk management.
It is. It protects the firm from massive tail risk events. And for the same reason, they heavily restrict or outright ban news trading. Like there's usually a 2-minute blackout window around major economic data drops, like the US CPI, the inflation report.
Why? Doesn't the market move a lot during news? Isn't that when you make money?
The market goes completely insane. It's basically a coin flip. Algorithms take over, liquidity dries up, and the price can jump 100 points in a millisecond. If you are in a trade during that, your stop loss might not even trigger, and you could lose 10 times your allowed daily limit before the server even registers it.
Oh, wow.
So you cannot open or close a trade 2 minutes before or after that news drops. If you have an open position in that window, boom, you lose the account.
So you have to constantly monitor a literal economic calendar on top of watching the charts, managing your trailing drawdown rope, and making sure your trade size is exactly average.
Yeah, which is exactly why you can't just pick the best firm off a random list on Reddit. You have to match your specific trading style to the rulebook of the firm. It's like picking a specialized tool.
Give me an example.
If you're a scalper, someone who makes dozens of trades a day, holding them for seconds to grab tiny profits, you need a firm with no minimum holding time and super tight spreads. But if you're a swing trader, someone who holds a position for days or weeks to catch big trends, you absolutely need a firm that allows overnight holding and has very relaxed daily drawdowns. Otherwise, a totally normal overnight price swing while you are literally asleep in your bed will hit your trailing drawdown and fail your account.
Okay, I'm thinking about this consistency rule. You keep saying they want a repeatable, boring strategy. If they want robotic consistency making the exact same size trade at the exact same time, avoiding the exact 2-minute news window, humans are terrible at that.
Yeah, we are.
We are fundamentally flawed at being boring. We get emotional. We panic when a trade goes against us. We get greedy and double down. Can I just plug a bot in to trade for me? Take the human out of it entirely.
Ugh. Yes. Welcome to modern finance. Over 80% of all professional trading in 2026 is completely automated. It's algorithms talking to algorithms. It's huge. And a lot of prop firms have finally validated that reality for retail traders. Firms like the Fivers, Funded Next, DNA Funded, they explicitly allow what they call expert advisors, or EAs, basically bots.
Wait, so I can just buy a bot, load it on my computer, go to the beach, pass the test, and collect the payout, and there has to be a catch. That sounds way too easy.
The catch is the monitoring. Yes, they allow bots, but they heavily monitor the servers for what they call exploitative strategies.
Like what makes a bot exploitative?
High-frequency trading, tick scalping, latency arbitrage.
There you go again with the words latency arbitrage. Break it down.
Right, okay. Let's talk about server distances and light speed. Literally, the speed of light. Latency arbitrage is basically when your bot is so fast and positioned so close to the actual exchange that it sees the price change on a direct data feed a fraction of a millisecond before the prop firm's server updates.
Wait, how is that possible?
Let's say you rent a virtual private server, a VPS, in a data center in Aurora, Illinois, which is physically right next to the Chicago Mercantile Exchange. You are physically closer to the data.
Okay.
But the prop firm you are trading with has their server located in London. Because of the physical distance the fiber optic cables have to run across the ocean, It takes maybe 40 milliseconds for the price update to hit London. Your bot in Illinois gets the data in 1 millisecond.
So your bot is basically living 39 milliseconds in the future.
Exactly. Your bot sees that the price of gold just jumped. It instantly buys gold on the prop firm's London server at the old, slower price. A split second later, the London server catches up, updates the price, and your bot instantly sells it back. You make half a penny.
That's brilliant, though.
But your bot does this 10,000 times a second. It's not real trading. You aren't analyzing the market. It's just stealing pennies through physical server lag. Firms will ban you instantly for that, keep your evaluation fee, and blacklist your IP address.
Okay, that is wild. But let's say I play by the rules. I have a good bot that just trades normal patterns, or I'm just a really remarkably disciplined human being. I pass the test. I don't hit the daily drawdown. I don't trade during the CPI news blackout. I pay my activation fee. How much can I actually manage? Like, what is the end game here? Why are people going through this torture?
The end game is scaling. It's managing massive amounts of capital. But honestly, I need to hit you with one more stat first before we talk about the $1 million dream.
Yeah.
Because I need to ground this in reality.
Oh, God. Every time you say stat, it's something depressing. What is it?
Only 7% of traders ever get a single payout.
7%? Wait, out of the 10 to 20% who even passed the test in the first place.
Right. If you look at the total pool of everyone who buys an evaluation, only 7% actually survive long enough in the live market to request and receive a physical check. 93% of people walk away with nothing but lost fees.
That is just, I mean, why do people even do this? If I told you a restaurant had a 93% chance of giving you food poisoning, you wouldn't eat there.
Because if you were in that 7%, the scaling is real. It is life-changing money. Apex, for example, lets you manage up to $6 million in capital.
$6 million. They just hand you a login for a $6 million account.
Not exactly. They don't give you one massive account. They let you manage up to 20 separate accounts, each maxed at $300,000. So what you do is you run a piece of software called a trade copier. It runs in the background. You take a trade on account number 1, say you buy one lot of the S&P 500. The trade copier software instantly mirrors that exact trade across all the other 19 accounts simultaneously.
Wait, so you are trading 20 accounts at the exact same time?
Yes. There are guys like, there's this trader in the community named Alex who got to over $1 million in funded capital in about 6 months doing exactly this. He passed multiple evaluations, linked them all together, and just scaled up his leverage.
Wait, I'm thinking about the logistics of this. 20 separate accounts. So as your account grows...
You just keep adding more accounts to the copier software?
The goalpost moves? I was going to say the goalpost moves. Why wouldn't they just give you one big $6 million account? If you proved you can trade, just give you the big account. It's because managing 20 sets of trailing drawdowns, paying 20 separate activation fees, monitoring 20 different data feeds, it makes it exponentially harder.
Kinda, yeah. I mean, not exactly, but yeah, kind of. From the firm's perspective, it's risk dispersion. They don't want all their financial exposure tied up in one monolithic account where one fat finger mistake could wipe out $500,000 of their liquidity.
Risk dispersion. That is a brilliant, beautiful corporate excuse for making it administratively impossible to hold a massive account. You slip up on one rule, you hold 1 second too long during a news event, and all 20 accounts blow up at once. It's not a bigger boat. It's tying 20 dimmies together. One leak, and the whole fleet sinks. That's why they do it, isn't it?
Well, yeah, if your trade copier replicates a bad trade, you blow 20 accounts simultaneously.
Yeah.
You hit 20 drawdowns at the exact same millisecond. That happens all the time. Guys lose $500,000 in funding in one afternoon.
Jeez.
But flip that around. If it's a winning trade, you multiply your profit by 20. You make $1,000 on one account, you just make $20,000 in a day. It's leverage. It's extreme asymmetrical leverage. Look, scaling to $1 million is exceptionally rare. I am not selling that dream. Most people never scale beyond their initial $50,000 account. The psychological consistency required to not hit a drawdown for months on end while steadily pulling profits and managing trade copiers is its professional athlete levels of discipline. It is a grind.
I am genuinely exhausted just listening to this. Like, my heart rate is up just thinking about managing 20 trailing drawdowns.
I mean, that's the reality of it.
Yeah.
It's not a get-rich-quick scheme, no matter what the guy leaning on a Lambo in the ad says. It is a highly technical, highly stressful profession.
So what's the takeaway here? Because honestly, for me, sitting here listening to all of this, the biggest thing is that 70 to 147% revenue model you mentioned at the start. That stat is stuck in my head. The fact that the entire industry is built on the graveyard of failed evaluation fees, it completely changes how I view those Instagram ads. It's not, we want to fund you, it's, we want your entrance fee because we know you're statistically going to fail.
I see it slightly differently. It's not a scam, but it's an elite arena. Think about it like poker. If you walk into a high-stakes poker room in Vegas and you don't know how to count cards or read odds, the casino isn't scamming you. You are just the fish.
Yeah, that's true.
If you go into this prop firm space, treating it like a casino, buying one-step evaluations and swinging for the fences, you are literally just funding the payouts for the 7% who treat it like a boring, disciplined, everyday job. You are paying their salary with your reset fees.
That is a brutal way to put it, but yeah, that makes total sense. You're either the professional extracting the money or you're the liquidity providing it. There is no middle ground.
Exactly. The market requires a loser for every winner. Okay, I think we've kind of talked ourselves into a circle here and we've covered a massive amount of ground. Next time, I think we should probably look into how people are actually surviving this. Like, we need to talk about the actual strategies people use to pass the evaluation now that we know where all the trapdoors and hidden fees are.
If that's even possible. But yeah, I'm down to hear it.
All right, so as we wrap this up, if you were listening to this right now, here's something I really want you to chew on before you go buy an evaluation account. If 93% of people fail to ever get a payout, the real question you have to ask yourself tonight isn't which prop firm has the cheapest test or who has the best rules. The question is, am I actually a trader with the system, or am I just a gambler voluntarily paying a professional salary? Think about that. Catch you later.
See ya.